Hi, I'm James Robinson. This is the Stock Pick of the Week analysis of Gilead. This video is going to look at the dividends for Gilead. One of the things that gives me pause about Gilead is they didn't start paying dividends till 2014. However, they've paid more and more each year, and as the companies buy back stock, the dividends per share have gone up pretty dramatically. And so, again, we're willing to overlook that they've only been paying them for 5 or 6 years because they've been growing them so solidly, and they have enough cash in the bank, I think, to continue to do that. As always, when we look at a company's dividends, we look at them from 4 factors. We want to understand what the yield is and what the growth of those dividends over time is. We want to understand the dividend safety in the context of earnings. We look at the dividend safety in the context of cash flow. And finally, we look at the dividend safety in the context of the company's current debt load. So starting with yield and growth, this company pays a 3.7% yield. The S&P 500 average yield is 1.92, so significantly above average. So that's fantastic. Additionally, the company's average dividend growth for the last 4 years has been 23.7%. Keep in mind that in 2014 they paid no dividends, so I couldn't go back 5 years. So we went back 4 years, and it's a pretty decent average growth, obviously. So good yield and good growth for Gilead's dividends. Dividend safety in the context of earnings. So the first thing we look at is the current payout ratio. That's the amount of earnings that the company is using to pay dividends. It's 54%. However, the average payout ratio for the last 5 years has been 35.5%. The average payout ratio of the S&P 500 is around 40%. So Gilead's payout ratio has been a little higher than we'd like. We'd like to see this dividend sort of stay where it is while the company increases its earnings, so its dividend payout ratio can get a little healthier. But it's not a major area for concern. The company has spent a tremendous amount of money buying back shares, paying off some debt, and so again, I'm not really that worried about this issue. So dividend safety in the context of cash flow, what we're really looking at here is does the company have enough money from free cash flow to pay its dividends safely? So let's look at 2018. The company had cash from operating activities of $8.4 billion. They had capital expenditures of $924 million, so call it $1 billion. That left them free cash flow of $7.5 billion, close enough. And they paid just under $3 billion in dividends. That puts their payout ratio at 39.7% or 40%. Not bad. The average payout ratio for the last 4 years, remember they didn't pay dividends for the last 5 years. Usually I look at it for 5 years, has been 22%, so obviously that's much healthier. So we'll keep an eye on this. If this number continues to get higher, then we have to start doubting the company's ability to pay dividends. But for now, we're okay with it. Anything under 50% of free cash flow to pay dividends is really okay with me. Dividend safety in the context of debt load. This is one of the first companies that I'm recommending to you where this actually becomes an issue. And it becomes an issue sooner than you would think. If the interest rates were to go to 10%, then this company would be paying an additional $1.3 billion in interest. So that would reduce their cash flow to $6 billion. They pay dividends of 2.97. So the cash flow minus dividends is 3.124, which means they'd be paying at 10% about 95% of their income, of their cash flow in dividends, and that's obviously not sustainable. That's too high. And in fact, if the company went to 12% interest, the company would be paying more than 100% of their cash flow dividends, and that's obviously a recipe for disaster. The only reason that I'm not very worried about this, and we talked about this earlier in the operations or in the debt section, is the company has plenty of cash. The company has $20 billion plus in cash and could pay off significant portions of its debt if they choose to. They're choosing not to, but they could if interest rates were at 10%, and I think they probably would. So it's not the end of the world because there's some context you have to have in looking at these numbers, but looking at this raw data, you can see where it's an area for concern.